This week's news is going to be the Fed. Taper or not to taper? Well, they're going to taper. And what that means to you guys, we're going to talk about in detail next. So don't go away. Okay, so what's going on? When you start saying tapering, what exactly does that mean? Well, I did about 400 takes on this, and then I found this video on YouTube, and I figured I would share it with you because it made more explanation of this whole process than I could. Then when I come back, we're going to go through, what do I expect this time tapering, and what's my projections for 2022 in regards to rates and housing. So watch this video, and then we're going to discuss it in more detail.
In summer 2021, several Federal Reserve leaders seemed to indicate the eventual tapering of accommodative policy would start before the year ended. Basically, the Fed might start tapering off some of the bond purchasing it initiated in response to the COVID pandemic. That sounds like it could be good news. But when the Fed signaled it would slow stimulus after the Great Recession, the markets flew into what was called a taper tantrum. That doesn't mean the markets will react the same way this time around, but understanding how the Fed stimulus works and what could happen when it ends could help investors prepare their portfolios. First, it's helpful to understand how we got here. When the world locked down in response to the coronavirus pandemic, the U.S. economy got slammed pretty hard. The Fed slashed its target for interest rates and ramped up quantitative easing, or QE, seeking to shore up financial markets and stimulate the economy. QE is a tool used by central banks to provide liquidity to financial markets and keep money moving through the economy. Since July of 2020, the Fed has been buying $80 billion of treasuries and $40 billion in mortgage-backed securities every month. The goal is to lower yields. This makes borrowing for people and businesses cheaper, ideally boosting the economy. But by March 2021, unemployment had floated back down to 6% from a high of almost 15%, and inflation had ticked back above 2%. The economic freeze seemed like it was starting to thaw. In August 2021, the Fed signaled that it may be nearing the end of its QE program. The idea is that as the economy recovers, the Fed can stop buying assets and interest rates should return to more normal levels. This giant buyer leaving the market leads to a drop in bond prices, pushing up interest rates. This hopefully keeps the economy from overheating and slows inflation from rising to unhealthy levels. But the Fed doesn't immediately stop buying assets. Instead, it gradually backs off QE in a process called tapering. Tapering is part of the recovery process. It means the Fed feels the stimulus worked and they can back off a little. Basically, it's taking the foot off the gas, but not yet pressing on the brake.
Okay, that being said, now you can see what's going to happen is the Federal Reserve is going to start reducing the amount of bonds that they're purchasing. And they buy corporate bonds or treasury bills and corporate bills. And like she said, MBSs, mortgage-backed securities. As we know on the channel, mortgage-backed securities is the component, the bond that trades on Wall Street that is the biggest component of your mortgage rate. Okay, so when the Federal Reserve pulls out, that means the prices, as she noted, of the mortgage-backed securities will start dropping. And that's purely supply-demand charts, thus pushing up the yields. So let me explain how that works. And I explain it every day in my videos, but I found another video that helps put this in perspective for you. And in the video that I'm going to show you, he's referencing the Treasury bond. But in this case, just extrapolate that data and think of it as he's talking about mortgage-backed securities or the mortgage bond.
when you buy a U.S. Treasury security, you're essentially giving a loan to the U.S. federal government. And just as an example here, I have a U.S. Treasury security in which it says that the owner of this piece of paper will be paid $1,000 in 1 year. So if you buy this from the Treasury, maybe you're buying it from someone else, but let's just say that the government is issuing them right now. Let's say you buy it for $950, and the government will give you this security right over here. Now fast forward 1 year. Fast forward 1 year, you're holding this security, and what happens? So, all that stuff is written there. What happens a year later? Well, written on this security, and I've simplified it just for this example, it says the holder of the security will get $1,000. So at this point, the U.S. government has to give you $1,000. Has to give you $1,000. So when you look at just the money flows, it's pretty clear that you just lent the money. You gave them $950 now, and then a year later, they give you $1,000. And if you wanted to put this in terms that you normally associate with borrowing money, in terms of how much interest did you get, well, you lent $950 and you got back $1,000. So let's think about it this way. Let's get a calculator out. So 1,000 divided by 950. 1,000 divided by 950 is equal to 1.05, just to round it, 1.053. So you got 1.053, or 105.3% of your money back. So let me put it this way. So this is 105.3% of money lent, of money given to the government. Or another way to think about it is you got a 5.3% interest, or if you lent your money out at an annual interest of 5.3%. You got your money back, plus you got 5.3% after 1 year. So you could imagine if all of a sudden many people want to buy this government security, and now the price goes up. Instead of being $950, let's imagine that it is now $980. What is the implicit yield that the person would now get on it? Well, we get the calculator back out here. So if you pay, so you're going to get $1,000, and if you paid in $980 instead of $950, then a year later when you get the $1,000 back, that'll only be 102% of your money. So in that situation, it would be 102% of your money. So in the $950 price, you're essentially lending the government money at 5.3%. And at $980, you're lending the government money at 2%. And I'm doing this to show you a point. When the price of the Treasury security goes up, as happened in this case, the yield, the interest that you're getting on your loan goes down. Because in either situation, you're going to just get $1,000 back. If you lend $980 and get $1,000 back, you're only getting 2% on your money. If you lend $950 and get $1,000 back, you get 5.3%. And so this is what people are talking about when they say if Treasury prices go up, then the yield goes down. So if there's more demand for Treasuries, the interest rate on Treasuries will go down.
So why is this week such a big to-do? Well, Federal Reserve Chairman Powell just came out and said this.
Fed Chair Jay Powell making some headlines today, saying the Fed is on track to begin tapering, with that tapering set to be completed by mid next year. Brian Chung, as always.
Okay, now let's get into the nitty gritty. All right, so let's look back where rates are, because the whole thing is rates are going to skyrocket to the moon. Nobody can buy a house. So let's go through some historic data just over the last few years. Where has rates been? Okay. So I expanded my chart back, and this is what's going on with the MBS market. So again, this is why people follow me on a daily basis, is what's going on with rates, and then that can extrapolate to the housing market and everything else. But you can see back in this time duration of November of 2020, all right, well, let's go back even further. December 19th of 2019, that's where we're at. Mortgage-backed securities were all the way down here. And again, guys, remember, as this goes up, okay, as the price goes up, rates come down. All right. So back here, they were much higher than where we are today. All right. So that being said, can we get back down to these levels? You betcha. All right. And how were rates here? They were out 4%. All right. So then we rallied. And then, everything else happened and so forth. So, but again, a year ago, rates were about 4%, 4.25%. Okay. So it's not there. We're not going to, or getting into uncharted territories. That's number one. If rates go all the way back to 4%, is that going to crush the economy and crush housing? Well, let's find that out. If you go to my website, therateupdate.com, and plug in or just hit buy a house and hit mortgage calculator, here's what you're going to see. A $250,000 purchase, you can get away with 5% down right now. We even have programs for first-time home buyers at 3% down. So call us and find out what you can do. But at 3 or 5% down at a rate of 3, where does that put our payment? I'm not changing anything else on this screen. I'm leaving it as is. So I'm not manipulating numbers. The payment would be $1,416. Okay, that's at 3%. How about if we went to 3.5%? $1,481. All right, from $1,416. So would you not buy a house for an increase of $60? You'd probably still buy it. Okay, let's say they got crazy. They went all the way back to 4%. What's that do to you? $1,548. Well, so if you went from a 3% rate at $1,416 payment to a 4% rate at $1,548, that payment only goes up 9%. Okay, you're probably going to say, Dan, that's 9%. That's a big increase. Well, I was able to find an in-depth rental report, and let's look at this. Nationally have been rising rapidly throughout 2021, and Zumper's October data shows the trend continues. Since March of 2020, the median one-bedroom home rent went up 11.8%, and 2 bedrooms went up 14.3%. Guys, are you starting to get what I'm saying? So let's break this down. If you're looking to buy a house, somebody commented on the video did that last week. What's your options on where your housing is? You can live with your parents. A lot of you don't have that option. You can buy, you can rent. So housing payments aren't skyrocketing. Rents are skyrocketing. So now you can rent or buy. Only you guys can decide on that. And one last food for thought. The Federal Reserve is not going to let rates get completely out of hand and dry up the housing market because of this. This is the misnomer in the background. You realize home constructions or housing constructions contribute 15 to 18% of our GDP. So if the Federal Reserve let rates just get completely out of hand, this is going to shut down the housing market, and we already have reduced GDP in this country. So they're not going to let that happen. So all I'm saying is I'm just trying to give you the facts. The QE is coming to an end. The Federal Reserve is going to start tapering. Rates are probably going to go to 4%. But is that going to stop you from buying a house? Only you can decide. So hopefully you found value in my video. If you did, please give me a thumbs up, subscribe down below, hit the bell every time I'll post a video, you get an alert. How do you find out more about me and my team? Well, if you want to get pre-approved for a house or look and see what you can do in regards to refinancing, the best way to reach out to me and my team is go to therateupdate.com, and it's going to take you right here. You can do multiple things on here. You can apply for a loan. Hit there. We have a state-of-the-art online application. You click it and you're on your way. You can give us a call, 844-775-LOAN, or you can schedule an appointment with me or one of my mortgage advisors. Click here and schedule that time. We have a new feature on here. If you would, you can go in here. Within 3 days of you inquiring about a mortgage with a lender, they're going to pull your credit and they have to issue you a disposition on your loan. What they normally do is send you out what's called a loan estimate. That loan estimate breaks down your entire loan, goes over the rate, the fees, and everything else. What I want you guys to do, let's see if we can beat that for you. Go into resources, go into upload your loan estimate, and go in there. You're going to be asked a couple questions just to let me know where you're at. And then you're going to upload your loan estimate. Give me about an hour. We're going to get back with you. and go over your loan estimate. And is there a better rate out there for you? Is there better fees out there for you? That's what we're going to do for you. We'll be your mortgage consultant. We'll help you find that best rate and lowest cost for you and your family. So thank you so much, guys, for watching. God bless, and I hope to see you again. Bye-bye.